we always begin with our real estate market update, and Danielle's going to give you a mortgage market update as well. When we're looking at this slide here, a couple of numbers really jump out at me, and I will let you guys know on these things. Sales, you see the very first column the very first row, or column and row over here on the right. Sales year over year are down almost 24%. That is the big one. And why is it that way? Because if you look at the line, 2 lines below that, inventory is down 30% as well. We don't have enough inventory. It's basic supply and demand. There's not enough properties on the market right now and too many buyers. Now you can take this situation and pretty much spread it all across North America, and you're seeing the same thing. You're not seeing the price increases that you're seeing here, but you're seeing a supply crunch. And we will actually go into that probably in our mid-year review of why we're in that kind of situation. But before, that's a whole seminar. So we're just going to keep looking at this graph right here. You look at the average price. The average price is going up year over year. We are up almost 2%. Mm-hmm. Now, if you read the press and talk about Toronto, which, as I was mentioning, a couple of investors, you can tell that story that you told to Danielle earlier. Yeah. Toronto's market, the prices are going down. Calgary's market, they're going up.
Yeah, so a couple of things going on here in Calgary. First of all, we have the affordability here. We have the infrastructure. We have jobs. We have good paying jobs as well. And so people, there's more than ever, Tim, well, I don't know what the number is of people moving to Canada right now. There's more people moving to Calgary. And there's, Tim, I just want to mention this as well. Edmonton and Calgary are not the same. Edmonton, there is a big difference right now in price. And why is that going on? It's because Calgary, I know people are going to hate me for saying this, people just want to move here. That's just what's happening. There's relatives here, or there's jobs, there's affordability, there's no place to live, but people still want to move here. And then what's happening in Toronto, it's too expensive. If you could imagine those mortgages buying at those prices, like the average thing was over $1 million.
Still is.
Your mortgages rates have doubled, right? So you can imagine the payments on those things. People are getting out there and moving west. So that's what's going on. And people aren't selling here. We're not getting the listings because there's nowhere for them to move to. If they're upgrading, they're going to normally, depending on what price bracket, they're going to just be spending more money. So it's a bit of a catch-22 where this is just going to keep going, Tim, with these numbers. And we're nowhere near, if you're just getting into investing, you could watch videos on our YouTube channel for like 3 years ago. We said we should be at an average of 650,000. We're nowhere near that. We still have...
if you look at the screen right there, it's 540,000. That's our average.
So we still have a long way to go in Calgary. How long is it going to take to get there? We don't know. But with the rate of the population growth, it's going to get there quicker than sooner.
Yes. And the final one I want to look at is the bottom line on their days on market. You can see year to date, the average days on market are 26 days. Normally, when we're in a normal market, it's anywhere from 30 to 60 days for a property to sit on the market before it's sold. That 26 days includes the conditional period, which is generally 12 to 14 days. So we're looking at actually a house being on the market for just over 10 days. Yeah. And we're seeing that over and over again with people getting into multiple offer situations, with houses selling the same day they're listed, cash offers, cash buyers out there. So it's a bit hairy right now if you're a buyer. So when we sit down with our clients, we always go through what type of market we're in and what to expect, and maybe how quickly you have to pull the trigger when you're writing an offer.
Yeah, and Tim's experienced that a couple of times this week while I was on vacation and writing offers. Tim, they're going into multiple offers still, and you have to be aggressive out there to get the property if you really want.
Yeah, and all property types are going into multiple offers. It used to be that mid-range, starter home to move up home. Those are the ones that were the highest in demand. Well, because the cost of a mortgage went way up, that drove a lot of people down in price range. And we're seeing multiple offers on the cheapest condos right now. Yeah. I was in Airdrie, we got into a multiple offer situation on a $220,000 2-bedroom condo on the main level of a building surrounded by other buildings. So, tons of the same product, but there were 6 or 7 buyers all putting offers in at the same time. So that multiple offer situation, goes right down to the inventory number right there. And you can see it's just over 3,000. If we see that inventory number drop below 3,000, it actually means somewhere around 1,200 to 1,500 active listings, because the rest of them are pending.
Yeah, it's crazy.
All right, so we will bring Danielle DeMarco in right now. Danielle, as you know, is our go-to mortgage broker. She helps all of our investors put their portfolios together and structure the financing on all of their properties so that they're in a better position than if they were doing one off with a bank and then one with a mortgage broker and then one with a credit union. Danielle looks at the whole picture so that your numbers work completely. So if you want to just jump in, Danielle.
Yeah, that's perfect. Thank you.
Okay.
So as Tim and Azad mentioned, we kind of had a conversation a little bit earlier to give you just an oversight of what the market has been doing on the mortgage side of things. Our current prime lending rate is sitting at 7.2% now, which is quite a bit higher than just a couple of years ago even. We just saw a 1/4 point increase in July from the Bank of Canada. What are we expecting for that? We're hoping that there's no more increases in 2023. We're pretty confident that there's going to, not be any more increases. If anything, a 1/4 point, but again, they already raised a 1/4 point in July. We just don't see it happening anytime soon again. As far as fixed interest rates on rental properties, as the majority of you guys know, from being investors, rental property interest rates tend to trend higher than owner occupied rates. So we're kind of that high 5, low 6% range there. And then for owner occupied houses where the rates are a little bit lower, we're in that low 5% range now to mid 5% range. So with that being said, housing costs, food costs, travel, activity, they're continuing to be inflationary. So likely there's going to be a point later in 2023, more likely 2024, when these more inflationary areas of the economy are going to cool off. So, as we know, it takes about 12 to 24 months-ish for a single interest rate hike to actually trickle through and have a full effect on slowing the economy. So if you think about it, we had a first 1/4 point in March of 2022. Then, July of 2023 here, we haven't even seen the effects of those 2022 hikes. Then now we just saw another 1/4 point hike. So if you think about it, 12 to 24 months down the road is when we're going to start to see the effects of this recent hike that was about a week ago, sorry. So we have to keep in perspective things like the previous rate hikes that we've seen haven't had their full effect on slowing the economy yet. Secondly, how long can Canada and Canadians withstand the high rates before there's a significant negative economic impact? So one of those things, one of those questions is, how long are these rates going to remain high as a result of those two things? The unfortunate answer is that until much of the economic resilience we're currently seeing is suppressed or slowed, we're going to still continue to see these higher rates. And again, like we said, there's a 12 to 24 month typical delay period on these increases. So if we're in the middle of 2023, we're talking middle of 2024 to middle of 2025 before we're going to start to see a change in these to kind of combat the possible recession that might come as a result of these increases. But what does this mean for mortgage rates? What goes up to slow the economy down will eventually have to come down to stimulate the economy. So more specifically, after the Bank of Canada's reached its peak rate, it takes about 6 months for them to start lowering rates again. So in July of 2023, bond markets, they're projecting that the central bank might start to drop in mid-summer to fall of 2024. So we're talking again, at least a year away before we're going to start to see any of those rates come down. And likely we're going to be towards the end of 2024. And for those of you that have been paying attention, it started off saying, okay, well, 2023, we're going to see rates drop. Then it was like mid 2023. Then it was end of 2023. Now it's 2024. And now we're end of 2024 into 2025. So Everybody is talking, things are changing. It's an ever-changing environment. We haven't really seen this before. Like I said, with COVID, we had interest rates in 2008. There was an economic response to that. But this is different. COVID was different. The economy was hit, in a different way and in different reasons and harder in certain aspects. So we're going to have to see where this plays out, but likely 12 to 24 months minimum, and leaning toward the 24-month side before we're going to start to see things come down and level out. But again, like I said, what comes up to suppress the economy must come down to stimulate the economy. So we are expecting rates to come down, where they're going to settle likely high 3%, low 4% to mid 4% range. We're not going to see, the 2% and the 1% like we did during COVID. That's just not feasible. So that high 3 to mid 4 is probably where we're going to end up. But again, we're not going to see that for at least another couple of years. So that's kind of the take on interest rates and where they're headed. Now, as far as how we can, kind of combat those rates as investors, one of the big things is for any of you that own properties currently, we can look at refinancing those properties, taking maybe those amortizations that are sitting at 15 years, 20 years, and extending them back out to 30 years, which, would offset the higher interest rates and help keep your cash flow in a more positive light. The benefit to doing that also is that obviously the lower the payment on that property, the easier it is to qualify for additional properties. But another tactic of refinancing is taking out equity. So if you have an existing rental property, let's say, for example, or multiple properties, let's say, and you pull equity out of one, you can use that equity to renovate any of your properties. We could add legal suites in, which gives you additional rental income. So if you can imagine, if you can have the same payment with one level of rent on, let's say, a main floor, but if we can add a legal suite in and we can double that rent that we're getting almost, then that's going to have the same mortgage payment, but getting double the rent, you're obviously going to have more positive cash flow. So refinancing to take out equity to do those improvements to legalize suites is becoming increasingly popular for that reason. And then considering a higher down payment. So, there's kind of two mindsets of investing. One is, well, let's leverage the banks. The other is, well, let's put more down. Let's avoid CMHC, and let's, put more of our down payment down. Both are great depending on the type of investor you are. When we're in a market like this, where we're seeing these higher rates, for those that have the ability to put more down, it might be a great option because it will help keep your payment lower. In addition, let's say rates do come down in the end of 2024 into 2025, we can look at that time at refinancing and possibly lowering the rate down at that time and pulling out some of that equity. So let's say you start with a 20% down payment, you pay down your mortgage for a few years, we have property growth, we're not expecting that to slow down. So property growth for those few years, that creates the perfect storm of, okay, well, let's refinance, pull out a bit of equity, maybe lower our interest rate, extend our amortization out, and walk away with some cash back in our pocket that we initially put into the property as a higher down payment. So kind of that perfect storm is brewing in that next 2 to 3, well, 2-ish to 3-ish years there. So could be a good opportunity to put a little bit more in now and then pull it out at a later date as well. So those are just a couple of the ways that we are combating the interest rates. Tim and Azad are going to get into a lot more specifics as to properties and how to combat rates that way. If you do have any questions about rates, the market, how to structure your portfolio so that not only can you qualify for more, but maybe we can lower down some of those payments and help that cash flow, especially for those of you that have properties that are coming up for maturity and renewal. This is going to be a really, really important conversation to be having, to not just sign on the dotted line if you don't have to, and to kind of look and say, okay, well, how should I be structuring my mortgages now for the next few years here to get through this hump until rates come down? So feel free to reach out if you've got any questions, but I will leave you guys with that. And then Tim and Azad can get into cash flow as far as properties go.
Awesome. Thanks, Danielle. Yeah, that was awesome. Great information. And you know what? When I started investing and we got caught out, Tim, in one of the downturns, one of the first downturns, I think it was the financial crisis, there is no problem in reconfiguring your portfolio if need be. I always thought that would be the worst thing to do if you had to sell a property or you had to refinance a property. I mean, that's why we have properties at the end of the day, and we're just fortunate to have them. So having someone like Danielle, her details are up there in the chat. Take them down, because Danielle doesn't just get you a mortgage. For our clients, she gets you a mortgage plan. And when I say a mortgage plan, when clients work with us, we work out exactly where they want to get to, and then we put a plan together on how to get them there. It's not always rosy. We've had people come to us that could afford to buy an $800,000 home. We're saying, hey, no, don't do that. Start off with the townhouse, then we'll move you into a suite of property, and then we'll move you into a brand new home. And then that way they own $1.5 million worth of real estate, in a very little amount of time. So take down Danielle's number, and now we're going to get into our presentation.
Yeah, so thanks a lot, Danielle. That's always great information from you. And like Azad said, if you need some help restructuring your mortgages, give her a shout.